Most trading mistakes come from entering too late. Imagine this. You see a coin, it's in a strong move, but by the time you get in, the move is already over. The better entries usually come after the move during the pullback. And one of the simplest ways to spot those pullbacks is with Fibonacci retracements. So in the next few minutes, let's look at how to actually draw Fibonacci the right way, what counts as a real pullback, and why most people get this part wrong. Okay, but what actually is this tool? At a very simple level, Fibonacci is just a tool that helps you find where price might pull back before continuing in the same direction. But instead of thinking about it too technically, it's easier to just look at how price behaves around these levels. So let's start with a simple example. We're in an uptrend. Price makes a strong move up and then starts to slow down a bit. So what I'll do to enter at a pullback is map Fibonacci from this low up to this high. I've simplified the levels here just to highlight the important levels. Now 1 represents the starting points, while 0 represents the top, and everything in between just shows how much of that move price is pulling back. If price only retraces to around 0.382, it usually means the trend is very strong, and price isn't willing to pull back much. If it pulls back closer to 0.5, that's often where price begins to find support, and it represents a good discount zone to scale in. If it goes deeper towards 0.618, that reflects a stronger pullback and typically a great discount area for entries. But what many traders pay attention to is the area between 0.5 and 0.618, which is referred to as the golden zone. This is typically the most ideal entry for traders, especially when it lines up with other forms of confluence, because the pullback is deep enough to overvalue, but not so deep that the trend is clearly breaking. Now that we've covered the basic concepts, let's see how this actually looks on real charts. Let's take this gold chart here. You can see price pushing up quite strongly, forming higher highs and higher lows, which tells us momentum is clearly in favor of the buyers. After this move, price rallies and then starts to slow down a bit. And as traders, this is where things get interesting, because in a bullish trend like this, we're actually looking for a way to get in on the next move higher. So what I'll do now is bring up the Fibonacci tool on TradingView and map it from a clear low up to this swing high, usually including the full wick. And once it's on the charts, we can see price pulling back into this area, finding support around the golden zone before continuing higher. Now the default settings of the Fibonacci actually comes with quite a few levels, but personally, I like to keep things a bit simpler. So what I usually do is go to the settings and just focus on the key levels, mainly 0.382, 0.5, and 0.618. So I will uncheck the rest and make the color of every line whites just to keep the chart clean and easier to read. If you want, you can pause the video here and copy these settings. It's just enough to give you structure without cluttering your charts. Now, if this video has been helpful so far, don't forget to give a like and consider subscribing to help us grow this channel. And with that, let's look at the opposite side as well, because everything we just talked about works the same way in a downtrend. So instead of price pushing up, we now have a price moving down, followed by a pullback. And the process is exactly the same. We're just mapping Fibonacci from a clear high down to a clear low, and from there, what we're watching for is how price reacts when it pulls back into these areas before potentially continuing lower. Before we continue, there's one thing to keep in mind. Fibonacci by itself doesn't really give you an entry. It simply highlights areas where price might react. So what really matters is the price action happening around these levels and if there are any confluences in the charts. So in these charts, we can see that price is clearly in a downtrend, making lower highs and lower lows. So what I've done is map Fibonacci from this swing high down to the swing low to measure the pullback. And as price starts retracing, it moves back into this area, around the 0.5 to 0.618 region. But what makes this more interesting is not just the Fibonacci level itself. If you look closely, this area also lines up with the 100 moving average. So now instead of just one level, we have multiple things pointing to the same zone. And this is what we mean by confluence. When different factors come together in the same area, and as price taps into the zone, we can see it struggling to push higher, getting rejected, and from there, price continues moving down, following the overall trend. Now let's look at another example. Here we can see price moving up and forming a clear impulsive move. So again, I've mapped Fibonacci from this low up to this high to measure the pullback. And as price starts retracing, it moves back down into this area around the 0.5 region. Notice the confluence. This zone also lines up with the previous resistance turns into support zone, making this into a good long setup to take price higher. But aside from confluences, the next most important thing we gotta pay close attention to is the candle reaction itself. Ideally from this level, we want to see expansion candles paired with a break of structure to confirm the downtrend is over and price is ready to continue moving upwards, which we got over here. Now if I were to take this trade, I can simply enter after the bullish candle close with stop loss below the newly formed order block with a risk to reward ratio of 2:1. Now you might be wondering, what actually counts as a pullback? Because a lot of beginners assume that in an uptrend, it has to be a sharp move down. What I find is that pullback doesn't always have to be a sharp move down. Sometimes it's just price moving sideways, or just a small retracement within a larger trend. So you can still use the Fibonacci Retracement tool to map out these smaller moves within the larger move like what I did over here. Price ended up pulling back, hitting the golden zone before eventually going higher. So pullbacks don't have to be perfect, they just need to make sense within the trend. And when you start seeing it this way, Fibonacci becomes a lot more powerful. If you found this helpful, don't forget to like and subscribe, and I'll see you in the next one.